This one's pretty high level. We it'll give you kind of a pretty good idea of like what things can look like at a really high level. And if you really like buckle down and go, okay, this is what I'm gonna do. Like I'm gonna make a career out of real estate investing. This is kind of what this looks like. So I talk about Tim. I have some content too. I have a podcast that it's called the Live Big Podcast, LIVBYG. I talk about multifamily on that as well. So I talk about some of the GP and LP sides of doing syndication deals. And so I don't talk about that in this one. This is more like how you can do it on your own and high level stuff for like tax strategy. So anyway, I'll get started, and you guys can see my screen here, correct?
Yes, sir.
Perfect. All right. So this is the third of basically 3 levels of classes. This is going to be the advanced strategies class. Like I said, we've got an intermediate strategies, which will be again 2 months from now. We'll do that in June, and then in May. Actually, you know what? This is a makeup from March. So we have another session, I believe, on April 20th, which is going to be the intro class. I'll double check on those dates, but it's April, it's later in April. And then May will be the intermediate class, and then we'll do the advanced one again in June. So, but we'll get started here. So just a little bit about me. I'm a managing broker for Remax Alliance. I have my own real estate team, which is the Meta Homes, just on the screen on my shirt here. I specialize in people looking to build real estate portfolios and listings. So my team works more with people that are doing like first-time home buyers and things like that. But I help people with kind of building out a financial plan from a real estate acquisition standpoint and growing a portfolio. So I do a lot of stuff with 1031 exchanges and just overall building out that, like I said, that kind of financial portfolio and putting together a strategic approach to investing in real estate and helping from a tax standpoint. So I'm also a real estate coach and business coach, and I speak on real estate investing. So go to conferences and teach real estate investing. So this next page I call the prerequisites. It's not a prerequisite. If this is your first class, that's okay. You'll kind of see it at a really high level. And then if you want to come back and watch some of the intro classes and the intermediate classes, you're welcome to do that. But these are my 2 other classes. So it's the Real Estate Investment 101, Beginner's Guide to Successful Investing. We talk about house hacking and first rental acquisition. I get a spelling error there, sorry. And then scaling your investments, elevating your portfolio from 1 to 10 and beyond. That is kind of how to acquire, leverage, re-leverage, and exchange things in your portfolio. Man, I'm coming up with all these spelling mistakes. This is what happened if my wife doesn't go through these slides for me. So, and then scaling your investment portfolio. So pick up your second, third, fourth, sixth, 10th, whatever property it is. Okay. So those are what the other 2 classes are about. So this class is split into 4 sections. Okay. Again, we're talking a little bit more about a high level approach and how to understand how people that you see at high levels, especially like the wealthy real estate owners, how they kind of get away with the very little tax that they pay and how they leverage their portfolios to create losses on their taxes. And so we're going to talk about basically 3 things here. We're going to talk about depreciation, cost segregation, bonus depreciation, and real estate professionals. And these kind of all go together to get to the ultimate, I should say, like the pinnacle of real estate investing. So, Tim, you may be familiar with, some of the depreciation and cost segregation stuff. If you're going through the multifamily, this is how we make multifamily profitable as well. Okay. So we'll start with the depreciation. So first off, understanding what depreciation is and how it works in a real estate setting. Residential assets are depreciated over 27 and a half years, and commercial assets are depreciated over 39 years. Okay. And so the idea here is that, and this is where the power of investing in real estate really becomes kind of obvious. Most assets that we purchase can be depreciated. So if you're in a business and you buy a big, let's say you're a dentist or a doctor and you buy a big x-ray machine, that piece of equipment or farming equipment, for example, can be depreciated over its life. The thing about it is that piece of equipment also truly depreciates in value. So the power of real estate investing is that we get to depreciate an asset that actually appreciates over its life. It's one of the only things that we can really do that with, and that's what creates a tremendous amount of value in real estate investing. And so the active depreciation is basically taking a loss each year, assuming that the property is decreasing in value. So again, the value that we have here is that we get to depreciate an appreciating asset. Okay, so again, commercial real estate depreciates over 39 years, and residential real estate depreciates over 27.5 years. Most people that invest in real estate, what they're used to or what their CPAs understand, because there are CPAs that don't even understand this high level stuff. Most do what's called straight line depreciation. Okay, and so what that means is if you bought an investment property for $275,000, your straight line depreciation, okay, would be $10,000 per year. That's 275,000 divided by the 27.5. Okay, so each year you get to take a $10,000 loss on paper by owning that asset. Okay, so when depreciating asset, the building itself is what gets to be depreciated along with all of its components. You cannot depreciate the land. So in the event, for example, that you buy a property for, let's say, $500,000, you're not going to generally be able to depreciate $500,000. You're going to have a land value in there, and that can usually be procured through like your assessed value. So you can look at the assessed value on the property. You can also look at an appraisal report. So if you bought the property for $500,000 and you got an appraisal on it, generally they'll assess a land value to it. So let's say they assess $100,000 land value. Your depreciable basis is $400,000. Okay, does that make sense? Anybody have questions so far on depreciation? Max, I see you reaching for an unmute.
Okay, I think I'm unmuted now.
Yep, try to get closer to your mic. It's really muffled.
All right. I just don't want to make my face so big that it scares everyone. Well, anyway, here's my question. So you do a cost segregation. I guess that is ordinarily done through a CPA that knows about cost segregating the property. So far,
Yeah, we're gonna talk about cost segregation in the second piece, so I'll go over that.
okay, well, here's my question. I own an investment property for 27.5 years. Is it time to sell that sucker?
Yes.
No longer depreciate the rest of anything else off of it?
Yes, that's a great question. Yes. So yeah, that's a great question. So if you're doing straight line depreciation, in my opinion, the answer is yes, because you don't have a write-off anymore to offset the income that you have coming in. And so if you're cost segregating, it's even worse. You're probably not gonna last 27.5 years in cost segregation, and I'll show you why when we get to that point. But it's because we're front loading the depreciation. So that's a great question, and in my opinion, yes. Once you've run out of write-offs on the property, it's time to exchange. Absolutely. Yep.
And so that was the next question I had in mind was, because I think I want to keep property and just keep transferring it in my, or either to an estate or to family members, right? Rather than just selling it and realizing the gain, taxable gain. I guess the other thing I could, well, no, because 1031 exchange is just for personal property, isn't that right? It's not for investment property.
No, 1031 is for an investment property.
Investment, okay,
It's not for personal property.
Gotcha. Right. Okay, I'll just shut up and listen.
We'll talk about some of that stuff. That was a great question though. Okay. So let's go to kind of our next piece of depreciation. Okay, so let's look at what depreciation looks like in real practice. Okay, so let's say you use straight line depreciation of an asset over 5 years at $10,000 per year. Okay, you would offset $10,000 in rental income per year. Okay, so rental income is taxed as ordinary income. So you would generally be taxed on $10,000 at the same rate as your ordinary income. So let's say in this case, you had an effective tax rate of 27%. Okay. You made enough money that your overall effective tax rate is 27%. Okay. You would have deferred the $13,750 in taxes over that 5-year period. Okay. Because you would have taken $50,000 in income. Okay. And you would have depreciated $50,000. And so what happens is instead of having $50,000 in taxable income, which at 27% is $13,750, now you have no tax on that. Okay. So so whatever your effective tax rate is, because rental income is taxed the same as ordinary income, what we're doing is we're using that depreciation to offset that income. Okay. Along with other things, along with the actual expenses of the property, the interest, the taxes, the insurance, that type of stuff. So, but this is another level of allowing us to do that. Okay. Now, what we have to understand about depreciation is that this is not a tax exemption. Okay. This is a tax deferment. Okay. And so what happens is when you sell the property, okay, we have what is called depreciation recapture. Okay. And so depreciation recapture is the IRS saying like, hey, we allowed you to take a loss on this property over the last 5 years, but you didn't actually take a loss. So we want that depreciation back. Okay. Now, in the event that your property actually depreciated, you wouldn't have to do that. Okay. So if you sold your property for $50,000 less than you bought it for, you would not have to recapture that depreciation. But we all kind of know real estate goes generally in an upward direction. And so if we sell the property and we have a gain, the IRS is going to want that depreciation back, and they're going to do what's called a recapture. So in the last example, we saved $13,750 in ordinary income tax over a 5-year period. Okay. So when we sell the asset, the IRS is going to recapture that. And the recapture rate for the IRS, okay, is capped at 25%. So regardless of your effective income, the recapture rate is 25%. It can be lower than that, but it's capped at 25. Okay. So in this particular case, when you sell the property, you pay back the taxes that you didn't pay or that you saved. Okay. But in this case, you won't have to pay back quite as much. So you pay back $12,500. So realistically, the way I tell you to look at this is that you're not going to, yes, in this case, in this scenario, we have a small benefit here of $1,250. Okay. But in general, let's just say it's kind of a break-even thing. What it allows us to do is it allows us to take that $13,750 over those 5 years and deploy that, okay, as needed or as necessary, or as, to reinvest, and then pay it back when we're done with it. Okay. So how does this benefit us? Well, like I said, you're kind of just robbing Peter to pay Paul, right? Like I'm gonna save $13,750 and I'm gonna pay it back in 5 years. Well, if you can understand the concepts of future value of money, then you know that, even if we're break even on tax savings, okay, money now is worth more than money later. So if I can have my $13,750 over the next 5 years, and I can take that at, $2,500 a year, $2,700 a year, or whatever it is, and then I can pay it back 5 years from now, interest free. I'm going to do that 100% of the time, every single time. And so what happens is this may not seem like a big deal, but if you compound this, first of all, over more than 5 years, over 10 years, 20 years, okay, and you do it times 10, 15, 20 properties, it becomes really significant. Okay. And so so what you want to look at is you want to understand that doing this with one property, okay, it's not a game changer, right? This is not gonna like be the end all be all of how you grow extreme amounts of wealth, but doing it 10 times, okay, over a 20-year period, now all of a sudden we're looking at, instead of $13,000 saved in 5 years, we're looking at $137,000 saved in a 5-year period, and $250,000 in a 10-year period, right? And now if we redeploy that cash to purchase another piece of real estate, now all of a sudden we've got this tremendous benefit of being able to invest in another property with which should be the government's money at the time. Okay. And so on top of that, if we utilize 1031 exchanges when we sell the asset, okay, then the gains are even bigger because we defer that depreciation recapture. Okay, so if we take that property that we've had for 10 years that we've saved taxes on and we sell it, okay, generally that's when we owe the tax. But if we do a 1031 exchange and purchase a new property, now we just push that depreciation out further. Okay. So Deb just put a quick message in the chat here. What about the improvements about home improvements? Are they depreciated separately? For example, if you install a new dishwasher, do you track this separately? Okay, so Deb, great question. It depends on and this is something to talk to your CPA about. So I'll do my full disclosure right now. I'm not a CPA and I'm not an accountant. So I've just got a high level of experience and education in the real estate investing world. So there's a question to ask your CPA, but generally speaking, in the way that I tend to do it is, for me, if a dishwasher breaks and I put a new one in, that is a repair. Okay. So it's not like if I went in and did like, let's say I took out old carpets and put all new floors in, that would be a depreciable expense, generally speaking. Okay. Because it's not really a repair. But if I've got a dishwasher that doesn't work, okay, and now I put one in that's necessary for the tenant to live properly, that to me is a repair, and I use that as a straight dollar for dollar write-off. So if I pay $500 for the dishwasher, I'm writing that $500 off the first year. I'm not depreciating that straight line. Okay. Now, if you put $20,000 in new floors in, you cannot write that off in 1 year as a $20,000 expense. You really need to depreciate that. Okay. So again, that's a question for your CPA, but that's the pretty good overall understanding of how that works. Okay. All right. Yeah, Dawn.
So there is such a thing as a section 179. I don't know how it applies to rentals and investment properties, but there is a certain, it's called section 179 and it increases every year. So I don't know what the amount is. So that's something to look into. But I have a quick question personally. Can you turn a residential home into an investment because you've turned it into an Airbnb, but you're still living here? Because I'm thinking the 1031.
So if you're still living there and you Airbnb it, I would, and you're thinking about the exit strategy on the back end?
Yes, because we've talked about this. I'm definitely getting rid of this house.
Yeah. So I think I still call that my personal property, and I'm still going to take my personal property exemption on that.
Okay, that's what I thought. Anyway, thank you.
So there's no need to 1031. It just sell it.
Right. Okay.
Okay. All right, let's go to the next piece. So now what we're going to do is we're going to take depreciation, which we just learned about. Hopefully we have a pretty good understanding of what depreciation is, how it works, how we use it to offset our income. And we're going to take that to the next level. Okay. So the next level is what's called cost segregation. Okay. So cost segregation is a study that allows an investor to accelerate their depreciation or front load their depreciation. Okay. So it's a really powerful tool that helps offset massive capital gain taxes. And it's going to be used in an even more powerful way, which I'm going to talk about in our fourth section today, which is the real estate professional. Okay. So what cost segregation does is it starts with an on-site evaluation. So kind of what you were asking about, Max, was a firm. Generally, there's very specific firms that do this. Okay. And the firms that have to do it, they generally have to have an expertise in engineering, construction, tax law, and accounting, and they generally have to have those expertises all in one. It's not an or. It's not like, oh, I can find an engineering firm that can do this, or oh, I can find a construction firm. It's somebody that actually specializes in all these things. And these are generally the people that do cost segregation. So if you ever need a cost segregation person, I have people I work with, and I think they're fantastic. So I probably should have had her on this call to help run this stuff. But what they do is they come in and they perform basically like an appraisal on your property. But the report is much more comprehensive than an appraisal. And so what it does is it breaks out each individual component of your home into an asset class or into what we call like a bucket. Okay, and those buckets are 5-year, 7-year, 15-year, and 27.5-year buckets. So some of your stuff stays in the 27.5-year. That's usually like the structure of your home. Okay, you know, the stuff that's not really going to change. But there's things that the argument is that, you know, carpet, for example, you shouldn't depreciate that over 27.5 years. There's no chance that carpet lasts that long, right? So to depreciate over 27.5 years, you're going to be replacing carpet over and over during that period of 27.5 years. So what we do is we bring in a cost segregation expert that drops that carpet into the 5-year bucket. Okay. And so what happens is each of the items that are in the house are given a value, and then they're depreciated individually according to the bucket that they're placed in. Okay. So I'm going to give you an example here of what an analysis looks like. Okay. So the property is first broken down into the value of the building and the value of the land. So you can see that up top here. Okay. So in this particular property, the total cost that was evaluated was about $750,000. Okay. The building was 80% of that basis and the land was 148. So the total amount that can be depreciated on this property is 594. Okay. So that's where we start. Okay. And the first thing that happens, hopefully you can see these numbers on here. They're kind of small, but what happens is they look at this original asset basis. Okay. And then they say, hey, if you were to not do cost segregation, okay, this is the amount of write-off you would have during this period of time. If you do cost segregation, here's the amount. And you can see the difference on this particular property that without cost seg, and in the first basically, I think it was 6 months of this property, okay, we would have a write-off or a depreciation of $11,700. Okay. With cost seg, that amount jumps to $194,883. Okay, so it's massive. Okay, so I'm going to take it a step further and show you where that comes from. Okay, so what ends up happening is they give you this graph. Okay, and it takes the total amount of 594 and then it puts them into buckets. So on this particular property, okay, out of the 594,000, okay, which generally would be straight line depreciated at about $21,000 to $22,000 per year. Well, now what we're doing is 133,000 of it is going to be pushed into the 5-year bucket. Okay, so if you divide that by 5, that's how much is going to be depreciated in the first year. Okay, which is 26,792. But you're also going to get the first year of the 15-year bucket, which is another $3,500. And you're also going to get the first year of the 27.5-year bucket. So that's 14,807. So now in each of our first 5 years, our depreciation is $45,125. So instead of having a straight line depreciation of around 21 to 22 grand, now we're taking depreciation of $45,125. Okay. Questions so far on this?
Yeah.
Go ahead, Max.
So let's say we buy a duplex, right? So that's our investment property. One side has been fixed up, the other side, not so much. Things are still in okay shape, but not very much. How does that work? So, because you're buying a property that's already kind of been depreciated or has shown exhibited signs of use.
What do you mean that it's already been depreciated though?
Well, maybe I don't know exactly what.
Your depreciation schedule starts the day you buy it.
Right.
And so if you're doing some renovations, for example, okay, on one side or the whole thing, it doesn't really matter. Okay, you're either increasing your depreciable basis, okay, or you're taking a straight line deduction depending on what you do right up front. So you're doing one of two things depending on what you do with the property. So you put new floors in, you're probably depreciating that. Okay, you fix a broken window, you're probably doing a straight line deduction of that cost.
Right.
So if you put $20,000 into the property for renovation, if you really want to break it down, Okay, you can take it to your CPA and go, hey, I got $8,000 that I want to straight line deduct, and I got $12,000 that I want to depreciate, right? And so or $12,000 that I want to straight line depreciate. Okay, and that's going to be determined on whether it's a depreciable item or it's a repair or a fix. And we'll go one step further as we talk about this, but there's something called bonus depreciation, which we could talk about as well. It's when you renovate a property right up front.
Okay, yeah, that's where I was kind of getting to. Like you buy the property, one side, the previous owner had totally renovated and fixed up. So I get that you can, at that point you bought the house, from then on, you can depreciate on that segregation schedule.
Yeah, so if it's already been fixed up, you're depreciating that high finish side anyway. That's why your purchase price was elevated.
Exactly. But the side that it's not horrible, but it doesn't need renovation right now, like it was done 4 years ago.
Yeah, so then you can, depending on what you fix, if it's a repair versus an improvement, that's kind of what we look at. So try to think about repair versus improvement. And again, this is CPA questions, but repair versus improvement, right? Fixing a broken pipe, that's a repair. Okay, putting in new flooring, okay, that's an improvement. Okay, so I'll come back to that on bonus depreciation. Okay, so all right, this is what an actual report looks like on a cost segregation. Okay, so this report, by the way, is like 120 pages long. This is just one page. Okay, and which you can see, look what we're talking about as far as how they break this out. So you can see I picked a page that has 2 of the cycles on it here. It has a bunch of stuff that's in the 5-year cycle, and then they have a bunch of stuff that's in the 15-year cycle. Okay, but you can see what they price things out at. So this particular property had this nice stone retaining wall, and they're saying, hey, we can put that in the 15-year bucket, and we're going to give you $16,800 worth of value to that. Okay, but you can see how little they break it down. I mean, look at the refrigerator, the faucets and the fittings, the stop waste valves on the refrigerator. They break that out into a 5-year bucket for $54. Like, these reports are very intensive, and so that in the event that you end up in some type of audit situation, all you do is you supply this report and say, look, I didn't do this. I had a professional company that specializes in cost segregation, tax, and engineering and construction, put this report together for me. Okay, so it's a really high level report. So this is just an example of kind of what it looks like and how they allocate. And if you were to go through the report and add up all of these costs that are in the green over here, it would come out to be $594,800, which is the total appreciable amount. Okay.
And this is for a single family.
Go ahead, Max.
This is for a single family property, right?
That was a single family property that you were just looking at. Yep. And you can cost seg anything. You can cost seg a multifamily. You can cost seg any of it. Okay. So here's what the result is. This is what this looks like after your cost seg report. So your 5-year bucket has a total of 133 and change, okay, which is 26,792 a year. Okay, your 15-year bucket has another 15,000 or 3,500 per year, and the 27.5-year bucket has 407,000 or 14,807 for the 27.5 years. Okay, so instead of writing off 21,602 through straight line depreciation, okay, it looks like this. You more than double that for your first 5 years, but then you go down a little bit. And so what you were talking about before, Max, is when you said, hey, after 27.5 years, should I sell it? And I said, yes. If you cost seg it, okay, you might want to think about selling it before that, because if you start getting into the after 15 years, you're left with $14,800 in depreciation because you stole a bunch of it on the front end. Okay, you front loaded a bunch of that depreciation, right? And so, yes, you still have depreciation there, but if it's no longer making sense, where you've got a property that is just generating tons of cash flow, which is not a bad problem to have, right? But if it's generating a ton of cash flow and you're not able to offset it, okay, now we run into a situation where we run into a situation where, yeah, it makes a lot of sense to exchange the property and raise our cost basis on something new. Okay. All right. Okay. So so now we have depreciation and we have cost segregation. Okay. And we have seen how those things benefit. And so now we can take it yet again one step further. Okay. So we're going to talk about bonus depreciation. Okay. So bonus depreciation comes from the Tax Cuts and Jobs Act of 2017. And during that, we enacted what was called bonus depreciation. We've had bonus depreciation in the past, but it was different when it came in the Tax Cuts and Jobs Act of 2017. And what it does is it allows the investor, okay, to cost segregate an investment, which we just talked about, okay, and then take everything that falls within the 5-year bucket and take it in the first year. So now that property that we just looked at, that was $133,000 that we were going to spread out over 5 years. Now we can take that all in the first year. Plus, we can take the 15 and the 27-year buckets for the first year, which is another 17,000. So now we've got about $150,000 loss in year 1 on this property. Okay. And so the way that bonus depreciation was enacted was in 2017, that everything that was purchased through 2022, okay, could be pushed into that first year. Now we have what's called a sunset of this act, okay, and each year that bonus depreciation decreases by 20% until it disappears, I believe, in 2026 or 2027. 2, 3, 4, 5, 6 in 2027. Okay, so in 2023, that bonus depreciation was cut back to 80%. So 80% of what fell in that 5-year bucket could be taken all in the first year. Now that we're in 2024, we're down to 60%. Next year, it'll be 40%. The year after that, it'll be 20%, until a new tax code is potentially written. So depending on who gets elected into office this year, this 2017 Tax Cut and Jobs Act, this was a Trump administration law. And so in the event that Trump gets elected again, we may end up with another piece like this. And I wouldn't doubt that we see something like this again, because Trump benefits greatly, and his administration and his companies benefit greatly because he is a real estate professional. And so if he can use these tax benefits and his people can use these tax benefits, they're huge. Okay. So the way that bonus depreciation works, okay, is it allows us to basically take significant losses in the first few years of ownership of a property. So now you're going to defer any gains that you have. Okay. And so these losses on paper, the good thing about these is sometimes you say, well, why would I need $150,000 in losses in my first year? Maybe I only have $30,000 in revenue coming in. Plus I've got my other, I've got my other write-offs, my taxes, my insurance, my interest on my loan. Why would I need $150,000 in losses? And you wouldn't necessarily be wrong. We're going to talk about that in a minute. But you wouldn't necessarily be wrong, but just know that these losses carry over indefinitely. So if you stack them up front, it's not a big deal because you're going to use them eventually. And I'll show you how we use them kind of on the back end. Okay. So we can use those losses indefinitely, and we can use them at a later time when there are gains. So what happens is if, for example, we sell an asset at a significant gain, okay, sometimes we think about, we go, well, we got to do a 1031. Well, a 1031, there's some stress involved with a 1031. We've got a time period. We have to reinvest the money within 45 days, okay, or identify within 45 days and reinvest within 180. But if you've got a stacked up loss sitting there, $250,000 of stacked up loss, you could just sell the property. And let's say you took $150,000 gain, it would just take from that loss. And now you don't have to execute a 1031. And you can sell the property tax-free. Okay. So what we're doing is we're using one property, cost sagging it and depreciating it to offset the gain that we have on another property. Okay. And we're constantly moving money from property to property, moving things around so that the taxes never hit us. or at least hit us way further down the road. Okay, so if we look at our example, okay, that we talked about using our example of property that was placed into service in 2022, the bonus depreciation, I think I did my math wrong, but the bonus depreciation that you could take was over $200,000 in year one. Okay, so if that same property were placed into service in 2023, the bonus depreciation is reduced to 80%, okay, of the 5-year bucket. So now I get $160,000 that I can take in year one. And same thing in 2024, it's reduced to 60%, which still allows for, you know, $120,000 depreciation that we can take in year one. Okay, so when we take advantage of that bonus depreciation, Max, the other thing I was going to mention with bonus depreciation, and I don't want you to perfectly quote me on this, but there was a time, and there may still be a time, where bonus depreciation was also allowed to be used for improvements on the property upon acquisition. So if you bought a property and then immediately put a bunch of money into it, whether or not it was a depreciable expense or a straight line like deduction, you could deduct the whole thing. Okay, so it's like if you went in and did $50,000 worth of renovations, okay, upon acquisition of the property, as long as you did it basically upon acquisition, you could basically add it to your cost basis, but you could put it in that all of it in that 5-year bucket, and you could take the whole thing up front. Okay, so that was the other advantage of bonus depreciation. So again, you know, when we look at this, sometimes it doesn't look like a huge advantage, but then you look at it from like Tim's standpoint, where Tim's looking to do multifamily. You know, if you buy a $5 million apartment complex, and then you put $1 million in renovation in it, and then you cost seg it, you could take a $2 million loss in year one. And so imagine the type of gains that you could offset with that, right? And so we're going to talk about how that works here in just a minute. Okay, so there's a couple other advantages that I don't like to get hugely into, but there's some other things that you can do at a high level that will help you not only offset your tax burden at the end, but sometimes even eliminate that tax burden. And that's something like an opportunity zone. Okay, so if you invest in an opportunity zone, basically what that does is it allows the investor to offset some of their capital gain if it's held long enough. Generally, I think the number is correctly, if you hold it for 5 years, you get back 10% of your tax burden. If you hold it for 7 years, I think you get 15%. And if you hold it for 10 years, you get your gain completely free. So opportunity zones are generally areas of particular cities or, you know, wherever where the government is trying to encourage economic growth. Okay, so you know, if we've got an area, for example, I'm in Colorado. If we got an area in Colorado that's struggling from an economic growth standpoint, they can create an opportunity zone, which encourages investors to 1031 into something in an opportunity zone and hold that and develop it and build it for 10 years, because then whatever they 1031 out of, their gain becomes completely tax-free. Okay, so that's how an opportunity zone works. It basically drives investor money into potentially low income areas or areas where they want to grow economic wealth. Okay, so other incentives and other investments that exist. This was also part of the Tax Cuts Act in 2017. There were incentives at the time that for gas stations and car washes, I don't know why. I can't tell you why those are the two pieces of commercial property that do this. But up until 2022, those investments in themselves. So I don't know if, let's see, Don, you're from Colorado. Tim, you're from Colorado. Max, are you from Colorado?
Phoenix.
You're from Phoenix. Okay. So I think Joseph's from California. A couple other you guys, I don't know where you're from, but I don't know if you guys noticed, those of you who are from Colorado, have you seen over the last like 5 years, did you see a bunch of gas stations and car washes pop up? Like around me, there are car washes everywhere, right? And so the reason for that is because up until 2022, those investments could be depreciated 100% in the first year. Okay, so if you bought $1 million car wash you could take $1 million loss in year one. And if you think about how crazy that is, you can buy $1 million car wash for 300 grand. You only need the down payment. So $300,000 down payment, you finance the rest, and then you take $1 million loss. Like, that's incredibly powerful, right? The amount of money you can offset. And I'll show you how that works at a high level in our last piece here. Okay, so just remember that car wash, remember the car wash and gas station scenario, okay? All right, so let's talk about how we can kind of leverage the bonus depreciation. So again, when you're selling an investment property, you may end up with a large capital gain. So either A, you can use a 1031 exchange to defer that gain and kind of kick that can down the road, okay? But you can also offset that gain with a loss, okay? So let's say I purchase a property, or I'm sorry, let's say I sell a property right now, let's say in April of 2024, and I have a $250,000 loss on it, okay? Or I'm sorry, gain, $250,000 gain, okay? And let's say I put $250,000 in the bank from the sale, okay? So now I got $250,000 in cash, but I have a $250,000 gain, and my effective tax rate or my capital gain rate plus my depreciation recapture is going to leave me on the hook for, let's say, $80,000 in taxes, okay? So instead of paying that $80,000 in taxes, what I'm going to go do is I'm going to go take that $250,000. I'm going to put a down payment on $1 million worth of property. Okay. We put a down payment on $1 million worth of property, go buy a quadplex, for example. Okay. I'm going to do that this year. I'm going to cost segregate it. I'm going to push a bunch of the depreciation on $1 million up into the first 5 years. I'm going to use bonus depreciation to take 60% of that and drop it into the first year. And now all of a sudden on that new property that I just purchased, I got a $250,000 loss. So now that $250,000 gain that I owed $80,000 in taxes on, all I did is I bought a new piece of property using $170,000 of my money and $80,000 of the government's money that I was supposed to pay them. I used that to go buy $1 million worth of real estate, front load it, and defer my taxes again. Make sense? Like pretty powerful stuff. Okay, so this is the way that at a lower level, if you talk to somebody about investing, okay, and I was one of these people, so this is why I say this. But at a lower level, I used to ask people, I would say, why not just do a 1031 exchange? Like, you should always do a 1031 exchange and kick the can down the road. And they go, not really, because if I kick the can down the road, it means at some point I got to pay my taxes. But if I offset my gain with a loss, it's gone. Like, that tax is never paid. That 80K is gone. And so now do I have to like do the same thing with my new property, that $1 million quad? Oh, yes, I do. Okay. But that $1 million quad that I bought, now 5 years from now, it's worth $1.5 million. I sell it and I make $500,000, right? So now I got a capital gain of $500,000 and I'm on the hook for $150K in taxes. So what do? Take $500,000. I go put a down payment down on $2 million worth of property. I cost seg it. I write off $500,000 worth of losses in the first year. 150 in capital gains, gone. Okay. So at some point when I decide I no longer want to invest in real estate and I sell my last property, will I pay gains on that last property? Yes, maybe. If you take my intermediate class, you'll learn about exit strategies on how to not even pay gains on that. Okay, you turn that into a legacy portfolio, which you leave to your kids. You die with that last property and give the kids what's called step-up basis. They get to acquire the property at its current value, and all of those gains disappear, and your property gets transferred over to them free and clear of any taxes. So if you do things right, you can literally kick the can down the road, defer taxes, and we're talking, I mean, if you do this right, we're talking hundreds of thousands, if not millions of dollars of tax deferment. So you're using the government's money, you're using $1 million worth of government's money to continue to reinvest. You kick that can all the way down the road, until you die with your last asset, and let your kids inherit that asset, and that tax burden just disappears. It's crazy. And so when you think about like how some of these families, how some of these ultra wealthy families get super, super wealthy and rich, okay, I promise you, it's not because they make a ton of money, okay? It's because they preserve a ton of money, right? And so what happens is when you look at and yes, they make a lot of money, but they're not making hundreds of millions of dollars, okay? They might be making millions of dollars, but somebody who's making $1 million a year, you don't become like a centimillionaire by making $1 million a year. You'd have to work hundreds of years to do that. Okay, you don't become a billionaire by doing that either. If you make $20 million a year, you're nowhere close to being a billionaire. But if you invest it right, and if you get rid of your number one expense in life, okay, which for the average person, okay, the number one expense in life for the average person is their housing expense. Okay. If you go out and you make $72,000 a year, you make $6,000 a month, and you have a $2,500 a month housing payment, that is by far your number one expense. Because if you make $6,000 a month, your taxes might be $1,000 a month on that. Okay. So your number one expense is housing. If you make $100,000 a month, your number one expense is nowhere close to housing. It's taxes by far. Okay, because at $100,000 a month, okay, $1.2 million a year, you could have a $10,000 a month mortgage, which would be a beautiful home. Okay, you could have a $20,000 a month mortgage, which would be a castle, and it wouldn't touch the $40,000 per month that you'd be paying in taxes. So imagine if you could eliminate your number one expense in life. Okay, if you were making $100,000 a month, imagine what you could do with an additional $40,000 per month if you just took it and invested it. Put those types of numbers into a compound interest calculator and watch what that turns into over time. Okay, so if you can defer your taxes and use your income taxes that you're supposed to be paying to the government to pay for investments and then pay the government back later or not, depending on how you do it, it's incredibly powerful. Okay, so the downfall, I shouldn't say downfall, the con of everything that we just talked about was when you're investing in real estate, okay, real estate investments create what's called passive income. Okay, what we do in our everyday jobs is called active income. And the IRS sees those things as two very different things. Okay, so if I have my passive income over here, and I have my active income over here from my job that I work, okay, those are two different things, which also means losses are two very different things. So if I make $100,000 over here in my job, and I take $100,000 in losses over here on the passive side, those are not combined. So I'm still going to pay taxes on my 100K over here, and I'm just not going to pay any taxes on my losses because there's nothing to take. Okay, so if we were buying a bunch of real estate and we were taking a bunch of losses and we were front loading it with depreciation, like the thought process here is like, well, what's the point in having all this front loaded depreciation if like we can't use it? And you wouldn't necessarily be wrong. If you bought one or two properties, okay, and you bought them currently, for example, there would be no reason to cost segregate them. I would tell you, don't bother cost segregating them. You're already going to show a loss because your mortgage is going to be high right now. Your cost basis is going to be high. By the time you add all that in, it's going to far exceed the revenue that you bring in from a rental, and you're going to show a loss. So no reason to compound further losses at this point in time. Okay, so we'll go to the next thing here, which is what I call cheat code. And does anybody get my reference of the yellow? Tim, you get my reference? My up, down, down, left, right, BA start. It's not Mario, it's Contra. Okay, so anyway, this was a Nintendo game back in the 90s, and it was famous for having if you put this code in fast enough at the beginning of the game, it gave you I think it gave you 30 lives or it gave you unlimited lives. Okay, but you had to do it perfectly. But it was a cheat code. In my opinion, this and Mario did have something similar. You're right. So in my opinion, what I'm going to show you next is takes all these three things, which are, I think, admittedly are very powerful, and it exponentially grows those three things. This is, in my opinion, what I would consider to be the most powerful tool in financial, I don't know, in financial history. Like from taking the three things that we just learned and adding this last piece to it. Okay. So using the real estate investment vehicle, okay, like I said, is one of the premier mechanisms for wealth building. So if you do it as a real estate professional, and I'm going to teach you what that means, okay, it's cheat code. And I'll show you why. It doesn't work for everyone. Not everyone can do this, but you could set up a plan to get here. Okay. So if you can make it work, this is the most powerful thing that you'll ever see from a taxing standpoint. Okay. Somebody just left. I can't believe it. I'm about to just show like the craziest thing you'll ever see. All right. First of all, you have to be what's called a real estate professional. Doesn't mean a realtor. It doesn't mean a real estate agent. It means a real estate professional. And what that means is that you need to perform 50% of services, okay, in real property trades or businesses. That's called the 50% test. To put that into layman's terms, you need to work more than 50% of your job in real estate. Okay. So if you work in tech right now and you work 40 hours a week, and you manage a couple of rental properties, you are not a real estate professional. Okay. If you build your real estate professional or you build your real estate portfolio big enough to where you cut your hours back as a tech guy and you're working 10 hours a week and you're working 20 or 30 hours a week working on your properties, now we could be considered a real estate professional. Okay. So you have to pass the 50% rule, which is essentially 50%, more than 50% of, and I would say your income, okay, and your overall work has to come from real estate. So you can't, again, be in tech, make $250,000 a year, and then call yourself a real estate professional. Can't do that. Okay. You also have to perform more than 750 hours of service related to real property trades. Okay. So that's not that much. That's like 15 hours a week. Okay. So 15 hours a week, it's not really hard to do. If you get a portfolio of say 10 properties, I think it could easily be argued that you work 15 hours a week managing that. Okay. Or if you get short-term rentals or whatever it is, and short-term rentals work a little bit differently. And we could talk about that here in a second. Oh, that's actually what number 3 is. You can consider yourself a real estate professional for an individual property, not for the whole portfolio, but for an individual property, if you materially participate in that activity, which is essentially a short-term rental. So if you run a short-term rental, okay, you can designate yourself as a real estate professional for that particular property. Not everything else, but just that particular property. Okay. All right, so here's what this does. Okay, so how does the designation benefit me? Okay, so once you become a real estate professional, and again, those of you that are sitting around going, well, I have a job, I couldn't possibly be a real estate professional. I can tell you, if you grow your portfolio big enough, you can. Okay, and this works even better for married couples that file jointly. Okay, because what we can do is one person can have a nice level of income and use that income to invest in real estate, and then the second person can become a real estate professional and manage that portfolio. And once one of them is a real estate professional, now the whole tax return is filed as a real estate professional. Okay, so maybe you can see where I'm going with this, but I'm about to show you. So first of all, real estate professionals, number 1, are exempt from the net investment income tax of 3.8%. Okay, so this is implemented on a married couple that makes more than $250,000 per year and on an individual that makes more than $125,000. Okay. And how this works is if you sell a property, if you again, if you're in tech and you make $200K a year as an individual, if you invest in real estate, anytime you sell a property, in addition to the capital gains that you're going to pay a 3.8% net investment income tax. Okay. If you're a real estate professional, you don't pay that. So right there, you have a 3.8% tax savings. Okay. Now, this is where it gets really, really powerful. When you become a real estate professional, I just talked to you about those two sides of income. One's called active and one's called passive. Well, when you're a real estate professional, the passive income that comes in through your rentals and things like that, it's converted to active income. Why is it converted to active income? Because that's our job. Our job as a real estate professional. We manage these properties. My job is to make rental income come in. And so that is now active income. So if that's active income, then when we depreciate and cost segregate and bonus depreciate a property, and we take $100,000 loss, that $100,000 loss is not a passive loss anymore. It's an active loss. Okay. So now all of a sudden, all those losses that we were talking about that we said, Nick, why would you front load all those losses if you can't use them? It's right here. This is why you would front load all the losses. Okay. Here's how this works at a high level. If one of the people on your joint tax return can claim to be a real estate professional, they can convert all of their passive income / losses, which if we're running a real estate portfolio properly, it should always have losses. Okay, we should always show loss on paper. Okay, but we convert those losses to active. So if we do it properly, we're going to have significant losses front loaded on each property. Okay, then what we do is we take those losses and we use it to offset the active income of the other spouse. So now we're eliminating the tax liability on that person's income. So let's look at this. So if we take the example from the property earlier, a $200,000 loss could be used from the property we talked about, okay, on bonus depreciation. So what we can do is if my spouse makes $200,000 in a year, I can take that $200,000 loss, I can offset her $200,000 income, and we're going to save $50,000, $60,000 in income tax. So then what do I do with that $50,000, $60,000 of income tax? I go buy another property so I can do it again next year. Okay, so like understanding what you would do with an extra 50,000, and I want to go through a quick scenario to show you how this works at a really crazy high level. Okay, I have clients. I have a set of clients that we're building this right now. Okay, and there's people that have done this in the past, no problem. Okay, so take this scenario. You got a couple where you've got a really high earning individual. Okay, in this instance, it's a dentist, makes about $1 million a year as a dentist, runs a nice practice, makes $1 million a year. Okay, anybody know the tax burden on $1 million a year?
50%.
Hmm?
50%.
It's, what do you think, Tim?
I was just going to say, you know, if they're $1 million a year, if they're 25%, that's $250,000. So,
and it's more than that. It's about 40%. The effective tax rate of $1 million earner is about 40%. Okay, potentially a little more or a little less depending on your state. Okay, but effective tax rate's right around 40%. That's $400,000 in taxes that person would owe. Okay, so let's say the spouse in this situation, the spouse makes about $100K, not a bad income. Okay, but the spouse who makes $1 million, their tax liability is quadruple the income of the other spouse. So what do we do here? We take that $1 million and we start buying real estate, like a lot. Okay, we cost seg it. We buy a bunch of real estate to the point, and this might take 2 or 3 years, right? But if I can get that person who makes $1 million a year to put $250,000 aside, or even $300,000 a year aside, in 3 years, we can pick up, you know, $3-4 million worth of real estate. Now, $3-4 million worth of real estate might be 8 to 10 doors rental properties. That, in my opinion, would be enough to have the spouse quit their job and become a real estate professional. I think you could easily justify that. Okay, so now you lose $100,000 in income because they have to quit their job to do it, because we already said 50% of your income / 50% of your work or more has to come from that. So she can't keep her job, but she can quit it. And now she quits that job. She loses $100,000 worth of income, but now we cost seg and depreciate all those properties. Okay, and we offset $1 million worth of income. Okay, so we offset $1 million worth of income and we save $400,000. So we lost 100, but now we gained 400,000 in the tax liability. What do we do with that 400,000? Well, in this case, we gotta try to offset another $1 million worth of income, which is tough to do. So what do? We go buy a gas station, or we go buy a car wash for $1 million. And then what do? We cost seg it. We front load 100%. We take $1 million loss. Next year, we save 400,000. We go buy another gas station. We go buy another. Like, you could literally do this. Now, again, the gas station and car wash thing, that bonus depreciation is now down to 60%. But there are opportunities everywhere to move your money from a real estate standpoint that allow you to be in a situation where you could offset a tremendous amount of income. So now all of a sudden we put this at a really high level, and we have this really high earner making $1 million a year, and we can save the $400,000 tax burden that they have and reinvest that money. Like, that is massively powerful. Like, it's incredible. This couple, if they do it right, could go through their entire life and never pay income tax legally.
Wow.
It's absolutely tremendous, right? And so I don't know if you guys remember a year ago or two, might be a little longer than a year ago, maybe 2-3 years ago, but finally somehow Trump's tax returns came out. Does anybody remember what his effective tax rate was? It was 4%. Okay, so think what you will, and it doesn't matter what your political beliefs or affiliations are, and it doesn't, and we won't get into whether or not we think there was something else going on in his tax return, but Donald Trump is a real estate professional by trade. There's no doubt in my mind that it was possible to legally be at have a 4% effective tax rate for Donald Trump, who makes millions of dollars a year. No doubt that that's very possible for him to have done that legally, right? What happens is the general public doesn't understand that these strategies can be used. And so when they come out and they go, Donald Trump has a 4% tax rate, you pay 20, what do you think of that? And people are like, oh, that's crazy. He should be paying way more taxes. Well, first of all, I can promise you that the 4% that he paid was way more than all of us paid in taxes from a dollar standpoint, right? But at the same time, what he did on his tax returns, most of it at least, was very legal. Okay. Donald Trump took, by the way, a massive loss back in the early 2000s. He sold a building in New York at a massive loss. I can't remember what it was, but it was a massive loss. Okay. And that happened over the last 3 years in Colorado. We saw big commercial real estate sell for massive losses. So a lot of our downtown Denver high-rise buildings sold in the last couple of years. They were purchased originally in 2018 and 2019, and these were business parks, right? Big building business parks. Well, what did COVID do to business? What did COVID do to businesses? They sent everybody home. They killed them, right? They sent everybody home, and so nobody has to go to the office anymore. Okay, so now there's no need for big companies to rent out office space. So buildings that sold in 2018 and 2019 sold for $60 million. They sold 2 years ago for $17,000, or I'm sorry, $17 million. So we're talking a $43 million loss. Okay, that sounds absolutely crippling. But for capital venturists and people involved in that transaction, yeah, it sucks. It sucks to not make money. But those losses now, they get to take all those losses and they're 100% written off for the rest of their life. So so Donald Trump can make $1 million a year, $2 million a year, $5 million a year for the rest of his life. He's got a $100 million loss sitting there from early 2000s. Like the power of real estate and the ability to offset taxes, not only on the investment itself, but then pushing it over to the income tax side, is exponentially powerful. And so that's where you see people like Donald Trump. And so if you look at any people that are extremely wealthy, okay, they all own real estate for one. Okay. And another part of it, a lot of these people have some type of designation in their family or whatever it is as a real estate professional. And so what they ultimately can do if they're not a real estate professional, they just feed all the property under somebody who is. Right? So there's tremendous advantage here. So anyway, that's the end of my presentation today. This is my real estate team, and this is kind of what we specialize in. And also as a reminder, this is really pretty high level. I think you probably see that, but I want it also to just kind of turn a light bulb on to like how tremendously powerful this stuff is. And if you build things the right way, like you could do it. Like you 100% could do it if you were like, put your head down and go, I'm going to buy a property every year, every 2 years, every 3 years, whatever it may be. And eventually I'll become a real estate professional, or I'm gonna have my spouse quit their job and become a real estate professional, and start offsetting my income tax or offsetting their income tax. So it's really kind of crazy stuff. Okay. All right. Any questions over that? I know there's a lot there, but any questions? All right. Do me a favor if you would. This next slide, would you guys hit this QR code? This is like really helpful to me. It just gives me feedback on the seminar, like what the good points were, if I confused you on anything, because I practice this stuff so much that when I talk about it, I like second nature to me. And so sometimes I go through concepts and people are like, I did not understand. So if you would, just shoot me some feedback on there. It'll also ask you if you're interested in having like a one-on-one conversation with me or my team about it. Let us know. I'm not going to bug you if you don't. So like I use this truly as an educational series, and at some point I believe strongly that one of you will come to me and be like, hey man, I really appreciate your knowledge. I'd love you to help me in my real estate, with my real estate portfolio or building, but I'm not going to bug you. So in fact, Dawn did that. Dawn, do I bug you? I don't bug Dawn.
No, actually, I need you to contact me more since hopefully you've replaced that guy. Sounds like
Yes.
you may have actually replaced his
Yeah.
position.
Yeah.
So
Yeah. So yeah,
we need to talk.
I had a guy that specialized in flips on my team, but he like left 4 days after I sent Dawn over to him. So
But
so anyway, so Dawn, we'll chat.
Yeah.
We'll chat.
This really
So,
has me interested, though. I do bookkeeping and taxes, so I could follow. Now I really want to talk to you about all of this.
totally. So,
Yeah.
and then last thing is, so yeah, if you didn't do that survey, there it is again. And then I have a YouTube channel. I have a podcast, like I talked about. That's in the bottom left-hand corner there. And then there you go. Tim needs a bookkeeper. So I'll let you guys connect real quick before we get out. You guys can give a email address or something like that. So if you found me on Meetup, our Meetup stuff is there. I'm also I put these events on Eventbrite. So you can, if you have any friends or family or anybody that might be interested in hearing this stuff, please send them. Like I said, my next one is going to be the intro session, and I believe it's in person. So if you're local in Colorado, you want to come, our in-person stuff, we usually do it at a brewery. So if you want to come to one of our brewery events, I'll buy you a beer, and you can learn more about real estate investing. And yeah, so hopefully you guys enjoyed. Fill out that feedback for me. And any questions before we go?
I think that was a great meeting, and it kind of straightened out things for me.
Good.
I know
appreciate
a guy that makes $7 million a year. He's a high-end attorney in New York.
Can you send them to me? Can I talk to him?
Well, it's not funny. I mean, it's truth. I mean, it's an opportunity. I get that you laugh, but
And I'm serious. I'm saying, like, those are the people I need to meet. Those are the people that, and honestly, I think those are the people that need to meet me. So
you're right about that. And the funny thing is, his dad is I actually know his dad, who's 80 years old. I don't know his son, who's but his dad is an attorney, and he was a high-level tax attorney in Seattle. So it surprises me because his dad, who's my friend, told me his son he's a partner in this law firm, and he, for many years, he's a partner, so he makes $7 million a year.
Yeah, that's
Right.
awesome.
Yeah. And so I did the math on that, by the way, and it will take me 116 years to earn 7 million.
Yeah.
So,
Now we gotta teach him how to keep as much of that money as possible.
well, and that's the thing that struck me is that his dad is a high level or retired now partner in a law firm in Seattle, and he's a tax attorney. Believe me, he has plenty of money. And the fact that, and that's where I got the 50% is because his dad told me the guy makes 7 million and pays 50% of it every year out in income
It's
tax.
probably darn close to that. I think right now the top federal tax rate is 39%. And then if he's got a state tax rate on that, depending on if he's in New York, there's a high level income tax in New York. So he may be darn near 50%.
So that's the thing is, why does his dad, being a high level tax attorney, allow his son not to do something to reduce his tax liability?
Yeah, I don't know.
Crazy.
There's ways to do it. There's ways, I mean,
Yeah, I mean, you just went for one way.
his significant other whatever his significant other is doing, should quit their job and become a real estate professional. That's just the right off the bat.
Almost, she's a stay-home. She doesn't work.
Well, she should start working. She start working enough to be a real estate professional. So,
Makes sense, yeah. I'm gonna
all
talk
right.
about that when I see him, but thanks for your time tonight. It's really,
Yeah,
really valuable.
appreciate it. Thank you guys for being here.
Nick, call me.
Okay, all right, I'll call you.
I'm ready
Don,
for
I'll
the
call you
next-
tomorrow. I'll put you on my list for tomorrow.
All
Okay.
right, I got a 6.99 HELOC percentage, so,
I know we talked about that. Yeah. Okay. I'll call you tomorrow.
all right, thank you.
Yeah. Tim, thanks for being here. Appreciate you. Joseph, thanks. Dennerson, thank you. If you need anything, feel free to reach out. Always happy to help.
I got your info, cool. Have a
Take
great
care, everybody.